Thanks for joining and welcome to this month's monthly views. Last few days have been very eventful. Markets have been bleeding red. I think a lot of the discussion today will be around what we are seeing in the markets and what we are likely to see in the markets. Without taking further time, let's quickly delve into some of the questions that have come in. I've tried to collate all of the questions and just make it into short, pointers so that we don't spend a lot of time discussing individual questions and try to put all of that together. Uh, Many people have written in on my Twitter or email asking about how the market is going to uh, how the market is going to behave based on what is happening in China, the quantitative easing that's happening there, the political and the war kind of situation that's going on in Middle East, about the US Fed rate cards and the upcoming US presidential election. So let's quickly take a very broad, holistic view of what's going on. First, I think the market has seen a pretty sharp cut over the last couple of days. In fact, more than a couple of days. But what is not very apparent from the frontline numbers like the Sensex and the Nifty is that the markets have been going through a fair bit of stress in the last 2 months, and I'll touch upon that a bit later in this video. What is happening? I mean, when you look at the news around us, especially global news, what you're seeing is that the world has become suddenly, much more volatile. We're seeing too many uh, conflicts across the world. I don't recollect seeing so many conflicts in the last at least 10-15 years uh, popping up together. And my pet theory is that all of these conflicts is a part of a continuum, right? This is what happens typically when we see regime changes, or when a dominant power, economic, military, technology power is challenged, and that is what we are seeing today with China trying to uh, trying to take the US head on, and trying to establish their dominance over as being the most powerful country in the world. And over history, I mean, we've seen this kind of churn whenever two superpowers collide. So that's one. And I think the other side is that as a precursor to going into this kind of a market correction, valuations uh, were on a slightly higher side. I would not consider them to be alarming. I think we discussed that in the last month's video. And uh, and the market up move was and it continues to be supported primarily by domestic liquidity. What we are seeing in the last couple of days is, since China has announced some form of quantitative easing, a large amount of foreign flows have moved towards China, and that has created some sort of a fall in the markets. Uh, with respect to China, I think my opinion is slightly divided. I think short term, whenever you have a QE kind of a situation, an economy or the markets can do well. I'll not say the economy, but the markets can do well because, again, a lot of liquidity begins to chase assets, and everything said and done, ultimately stocks or asset prices are in the short term slaves of liquidity. So in the short term, there is a possibility that the China equities in China or assets in China could move up. But on the other hand, if you stretch the time horizon to slightly longer, I think the challenges that China faces, the Chinese economy faces, is actually very significant, and it's not likely that these kinds of QE is going to solve the problem. It is very similar. These are structural challenges that China faces. The geopolitical problem that US and a large part of the Western world are now wary of China. They don't want Chinese businesses to come in and dominate in their domestic economy, and we are seeing multiple such examples, whether it is with EVs getting taxed at higher rates in Euro zone or in the US, or whether there is a technology ban on exports from the US to China of chips and things like that. So this is going to play out over time, and it is not something that is going to just flip because China is pumping in money in their domestic economy. The second thing we need to understand about China, especially from a global perspective, is that the Chinese government has been a fairly unreliable entity in terms of policy matters, especially when it is with respect to treating private companies. So suddenly you find policy action which can come and completely disrupt a particular industry, irrespective of who has invested and how much has been invested in it. We've seen that with examples in the past with Alibaba and many other such companies in China. So that is something that the global investors will actually keep in mind. Some of the movement that we are seeing is right now is the tip of the iceberg, hot money kind of thing. But I think serious investors will pause and take notice of what are the structural challenges that is posed. Thirdly, I think the bigger, or rather the biggest challenge that China faces is that of an aging population. And if you look at history, you will find very few examples where a seriously aging population has been in a long-term bull phase for many years. It's very rare to find. Mostly what you will find is growing economies tend to do well, and that is, if you look at say US from 70s to even till today, it's been an expanding economy. Large part of it has been with new technology getting adopted. In China, we don't see that kind of power as yet. That people are not enthused enough to go and migrate to China, which is what the migration of high-end labor from across the world to US has been a major factor for the US to have been doing so well over decades. So these are small points, and if you look at what is happening in China, I mean, in terms of this the QE that the Chinese government has announced, in effect what is happening is or what will happen is Chinese government is going to finance it through bonds. Who is going to buy China bonds? Very unlikely that global players are going to come and invest in Chinese bonds because of the flip-flop nature of the government policies that I just mentioned about. So most likely it is going to be the Chinese banks and financial institutions. They are awash with cash. Where is that cash coming from? That cash is coming from the high savings rate of the people of China. So what essentially is happening is Chinese people are saving money because they are wary of the future, of their retirements and their future uh, income and prosperity. The government is taking that money uh, and routing it back to them for consumption. So that is what is happening in effect. Whether that helps in pickup of consumption, whether that helps in picking up of exports, etc., remains to be seen. So right now I am in two minds. I'm not very sure how this will play out. Short term, definitely positive for China. Medium to long term, I would still be very, very careful of how the Chinese economy fares. Looking at the global, US Fed rate cuts, I think that was because US is such a large part of the global economy. That is obviously very important. But we've actually seen rate cuts happening across the world. Uh, we've seen Japan cutting rates, we've seen Switzerland cutting rates, Europe cutting rates, Bank of England, Canada, everybody's cutting rates. So now it is pretty much certain that we are in a declining rate regime, and usually a declining rate regime is good for equities. So again, longer term, it is going to hopefully benefit equities as an asset class. Lastly, with respect to US presidential elections, I don't think it matters that much to Indian investors. Uh, when I look at the US uh, election, the way it is panning out, I think uh, there's not too much of a difference in terms of policies between the two that is going to impact India. I mean, for domestic US economy, they have slight differences, but from a global impact, I don't see that much of an impact which is going to be long lasting. Other than maybe some tariffs, etc., that is going to happen with China, and nothing that we've seen significantly impacting in the past. So that, I think, is the nutshell, in a nutshell, what is happening all around us. Globally, I think we are in a situation where uncertainty has spiked. We don't know what is going to happen with the Israel and the Iran situation. Russia Ukraine seems to be like a night without an end. It continues to go on for nearly 2 years. It's been on now. In fact, the Israel problem uh, is exactly 1 year today. I think October the 7th is when I'm recording this. So conflicts, their repercussions are that is around us. We've in India, we've going to have a couple of state election results coming up. We've got two more state elections coming up in later part of this year. But I don't think any of that is going to really impact the markets per se. I think the markets are going through a necessary phase of consolidation, like I mentioned. Uh, this chart I found very interesting, and that's why I thought I'll talk about it slightly. If you see the last 10 years, what has happened in the Indian equity market. So if you see the foreign portfolio investors, money has come in, has gone out in once in a while, but in general it's been positive. But what has been the remarkable difference is that other than 2020, which was sort of the COVID year, money has continuously flown into the domestic institutional investors. So whether it is mutual funds or insurance or structures like PMS or AIFs, money has come in droves. And the same situation is with the Indian individual investors. If you see post-COVID, I mean, COVID has been a watershed event in all our lives, not only because of something that we've never witnessed or never heard of, never thought of, never dreamt of before happened, and something that we will probably tell our children, grandchildren many years down the line is, we lived through a phase where all of us were sort of, we were sitting in our homes, we were not able to go out, and that happened for many months, and that was a unique situation. And what it sort of triggered was this entry of literally millions of people into the stock market, because a lot of them had nothing else to do. I think it was a kind of a Lollapalooza effect where there was these discount brokers, mobile phones were, and mobile connectivity was available very cheaply. We found a huge number of people coming into the markets. Uh, this is the next chart again in the same narrative, is bank deposits, CASA, which is current account and savings accounts, and FDs, have started giving way to pensions, equities, mutual funds, PMS, AIF. So again, this is a structural change which is driven by the sheer number of people that have come in. So demat accounts are at an all-time high. I don't have the numbers for the month of September, but till August, I think we had about 17 crore demat accounts. That is just phenomenal, right? And the number of active investors have gone up tremendously over the last 4 years, and a lot of these people have started doing their SIPs. The regulator is talking about micro SIPs, 100 rupees, 200, 500 rupee worth SIPs starting, and that is a very structural change. Uh, I see a lot more interest, a lot more understanding of the fact that equities as an asset class is something that we are under owned as an household, and that is what is sort of getting corrected. So I think this is a very, very positive sign for Indian equities over a long period of time. Again, the point that we were discussing about rate cuts. So if you see the rate cuts that we are seeing uh, since 2000, so practically this century, we've had uh, one of the largest number of rate cuts that is happening, and that's something which is very, very critical. We are seeing a spike, and this is happening without any large event. If you see in 2008-9, the rate cuts happened because of the global financial crisis. Same in March 2020, it was there because of COVID. So if you discount these two, which were event led, right now we are actually in a situation where global central banks feel that inflation is tamed, growth is sort of tapering off, and that is why the interest rates are starting to reduce, and it is not happening because of any external macro event which is creating a problem. So I think that is something that we need to keep our mind around, that these rate cuts are different in nature from the rate cuts that we have seen in 2008 and in 2020. And lastly, I think in with respect to the markets that that I was talking about, this is the advanced decline ratio for the entire NSE, and you see that month by month. Uh, if you see the last 2 months, advanced decline ratios have started going down. So in August it was 0.95. So what that means is, for every one stock 0.95, or so for every 100 stocks going up, 95 were going down, right? uh, no, it's the other way around. So advance for every 95 that were going up, 100 is going down. Similarly, in September, for 87 going up, 100 were falling, right? So basically, the overall breadth of the market was negative for the last 2 months. We've seen this previously in February, March, where we saw a correction in more of the small cap world, and we are seeing the same thing now. My view personally, and I could be wrong, Rakesh Jhunjhunwala used to say, and I love quoting him on this one. I reserve the right to be wrong. I think markets are in a consolidation phase. We've moved up very sharply over the last 1.5, 2 years. This is the phase, or this is the time when the market is going to process and digest those gains and create a base for the next move upwards. This base creation can take a few weeks, it can take a few months, but in the way I think the economy, the world, the markets are positioned, I think that we are headed upwards. If I look at the next 2 years, 3 years, 5 years journey, the only thing that I keep telling people all the time is remember that equities is an asset class which is volatile. It is not going to give you linear returns. It's not going to give you returns every month. If you've got great returns in the past, there's possibility that future returns are going to be mean reverting. That means that future returns are going to be on the lower side. Once every 4 years, you will see a fairly large correction. Every year you will see a 10-15% correction. Every 2 to 3 years you will see a 20-25% correction. Every 3 to 4 years you will see a 30-35% correction. So corrections are healthy. It doesn't obviously seem like it when you are going through it. There will be bounces up and down. You will see sharp up moves on the days when the market recovers. You will see absolute collapse, capitulation when the markets are down. I think today markets were absolutely bleeding red across. That's par for the course. There have been times when markets were tearing up in a rally. It's good that markets are giving these movements so that it lets all the participants understand that it's not an easy game. Making money is never easy, and I think that is healthy for the markets. It helps mature the investors who've been there. And I think right now the situation is that more than 50-60% of market participants are entrants who've come after 2020, right? So people who've got less than 3 or 4 years of experience, they've never seen a bear market, they've never seen sharp corrections in the market. So in a way, this is these kinds of days or weeks or months are going to be their trial by fire, and this is when you actually learn that being in the market is more important than panicking and getting out and things like that. With that, I think if the question could be that what should we do? What you should do is dependent on your time horizon and the kind of strategies that you follow. If you have a short-term strategy, you might want to book profits or losses, be in some portion of cash, or look at areas where there is market strength. If you are a long-term investor with a time horizon of more than 3 to 5 years, you can either opt to just ignore and sit through this kind of a movement and wait for the markets to settle down, and also the option of continuously looking for better stocks to replace the ones that you already have in the portfolio. That's the message I had for this month. Thanks for listening. Keep sending me any questions that you may have. You can do so on my Twitter handle, on LinkedIn, or send it to me on my blog or email. Okay, thank you, thanks again.